Hi friends, in my previous video I have talked about capital and money market and different instrument and tools of it. So if you want to watch that video, please go through that. You will have a good and comprehensive idea of financial market. But today I am going to talk about Reserve Bank of India. It may sound like an entity, but when you will understand its responsibility and how it plays a vital role in Indian financial market, so you will have a comprehensive idea of everything about our market. So today I am going to talk about its responsibility one by one. The first one is manager of foreign exchange. RBI has a responsibility to manage foreign exchange and its reserve and gold reserves. So what happens in foreign exchange market, when foreign exchange rates which fluctuates and it is highly volatile and dependent on demand and supply in the market. So when demands for foreign reserves gets high, so foreign exchange rate on that day, that very day, gets high. So to maintain its volatility, what happens? RBI plays a great role. It directly buys the US dollar when there is excess supply and sells it when there is high demand for it. So in this way, it controls the stability of foreign exchange rate. So now you can understand that how it plays a vital role in foreign exchange market. And the next responsibility of it is that it plays a debt manager of Indian government, a role of debt manager. What happens when government needs money? So it raises fund for government through different securities. It sells different securities and bonds, government bonds, for raising the money for the government. And the next that we all know that it plays banker of the government. It plays a role of that because it maintains all accounts of the government. It does payment for the government, it receives payment for the government, so it maintains account for the government. This is the role of RBI for as a banker for the government. The next role is issuer of currency. We all know that RBI prints money. It can print up to 10,000 rupees of currency and it can mint up to 1,000 rupees of coins. But right now coins and 1 rupees note are being minted and printed by finance ministry, but the distribution channel and the distribution responsibility is still in the hand of RBI. So RBI has 4 printing presses in India that we all know about. It is somewhere in Nasik and the second one is in I'm forgetting right now. There are 4 places in India that RBI used to print money there. And the next one responsibility of RBI is that it regulates the banking system. It gives licenses to the new banks. It gives criteria for maintaining capital for the different banks, and it also do on-site and off-site monitoring for the banks. The next role of RBI is that it does payment and settlement system of India. It regulates that. So in payment and settlement system of India, NEFT and RTGS, real-time gross settlement, and national electronic fund transfer, these are the channels by which it does payment and settlement across interbank or other financial systems. So it gives a secure and safe settlement for the peoples of India. The next role of it is it plays a development role in our economy. What happens? It regulates, lending norms for banks. It gives priority sector lending norms that this much amount of lending you have to do in priority sector. The next thing is that it gives instruction banks that you should open certain branches in rural areas. So it also plays a development role in our economy. The next one is the most important thing that I'm going to tell you, the monetary policy. It monitors monetary policy. What is monetary policy? You know, the availability of currency and liquidity of currency in the market and the cost of currency, it maintains through monetary policy. What is cost of currency? You know, deflation and inflation. Suppose certain day you are going to buy some certain commodities of 1000 rupees, and the same commodities you are going to the same outlet for next day and you are getting it in 1100 rupees. So what happens? The 10% increase in the requirement of money that you are having to pay more. So in one day you are going to pay 10% more. So what happens? Inflation, 10% inflation occurs. So to check that, to check the cost of currency, that you are having to pay more for the same commodities for only advancing 1 day. So to check that, it does monetary policy, and also it gives certain criteria to fulfill to the other banks in India so that it can maintain availability of the funds. In this, I am going to talk about qualitative and quantitative, that is broadly classified tools of RBI. The first one is reserve ratios. Banks has to reserve some share of their NDTL, that is net demand and time liabilities, with themselves to meet the cash requirement of their customer. So what is NDTL? Whatever we deposit money to the banks, this is actually a liability for the bank. So if you are going to over the counter and you are ordering the bank through a check that please pay me certain amount of money, so in time you are demanding and bank is going to pay you, so that is called demand liability. Okay, the next one is time liability for the bank, that after certain term, after certain period of time, bank has to pay that money. That is called term liability for the bank. So for the net demand and term liabilities, they have to maintain certain shares, certain amount, that is called reserve for them. In this, there are two reserves. The first one is SLR, a statutory liquidity ratio that bank has to maintain with themselves, and it is right now 20%. That means 20% of their NDTL bank has to maintain in cash form or in liquid form. It may be in cash form or in gold form or in government securities, bonds, that can bank keep to maintain its SLR, and it is huge. It is 20%. And the next one is CRR, cash reserve ratio. Bank has to maintain 4% of their NDTL in cash form. So these 20 and 4%, 24% bank has to maintain to pay, to meet the requirement of customers of their demand liabilities. You know, so this is the reserves which RBI may increase, may decrease on certain situation. Suppose government is anticipating that there is excess flow in the market. What it will do, it will increase the SLR. Suppose if the SLR, they will increase 20 to 30% and CRR from 4 to 8%. What will happen? They have to maintain 38% of their fund NDTL idle. They cannot use that. They can only lend 62% of their fund in the market. So what will happen now? They still have to make profitability in the market. What they will do? They will increase the interest rate on their lendings. Whatever they are going to invest in public, 62%, they are going to increase their interest rate. So what will happen? Public will not go to them because the cost of fund is getting higher and higher for them, for public. So what will happen? Ultimately, there will be decrease of fund in the market. So they will not take money again from banks in the market. So there is a control here. So this plays the vital role. The next one is open market operation. If there is excess liquidity in market, what happens? RBI sells securities. So people are going to pay them, financial institutions are going to pay them, and what will happen? Ultimately, they will soak out money from the market. And if there is a scarcity in the market, they will buy certain securities and infuse money in the market. And the next one is, policy rates. What are the policy rates? If bank needs money for longer period, they approaches RBI. So RBI charges certain interest on them, that is called bank rate. If for long term period banks are going to get money from RBI, so that interest rate which they are going to pay to RBI, that is called bank rate. And it does not play a vital role because this is for long term. So in short term there is a liquid adjustment facility, that is called repo rate and reverse repo rate. When banks go to RBI for short term funds, that is for overnight, they have to pay this interest rate, that is called repo rate. So often we listen that RBI decreases or increases repo rate to check the availability on the funds in the market, liquidity in the market. What happens? The same role will play here. What will happen if they will increase the repo rate? Banks will not go to RBI for receiving the funds, and ultimately there will be scarcity in the market because banks will not lend if they do not have funds. And what is reverse repo rate? It is just opposite to repo rate. Repo rate, bank has to receive money from RBI, and here if bank have excess liquidity, excess fund, they can park their money to the RBI and they will receive certain amount of interest, and that interest is called reverse repo rate. So there is always a question in sales services that why RBI increases or decreases repo rate and reverse repo rate together, although it is contrary, reverse repo rate and repo rate, but when they will increase repo rate, they will also increase reverse repo rate. So it is a concept of market. When there is excess liquidity in market, they will increase repo rate and also reverse repo rate. If they will increase repo rate, banks will not go to the RBI, and what will happen ultimately? There will be a scarcity of fund. And the same is true. If they are paying more reverse repo rate, bank will park their money to the RBI. They will not lend fund in the market. So again, there will be a scarcity of fund in the market. That's why they try to increase at the same time, they try to decrease at the same time. So this is the concept behind that. These are the quantitative analysis of monetary policies of RBI, which plays a vital role in our economy. So if you understand all these things, I think you will have a comprehensive and exhaustive knowledge of our market. So with this, I'm going to end this video. Thank you.